Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I will be your host today. And I am really excited. I'm a little starstruck, I got to be honest. We've got Jay Scott with us here today. Jay is the general partner for Bar Down Investments. He owns and operates 1,200 units in both single family and multifamily. He's the podcast host, or one of the podcast hosts of the Drunk Real Estate podcast, which is one of my new favorites. And of course, he's a best-selling author of 5 different books that are published through BiggerPockets. So, Jay, welcome to the show. So excited to have you here.
I'm thrilled to be here. Thanks for having me, Randy.
Fantastic. Well, let's jump in. For the rare audience listener that does not know who you are, can you share a little bit more about yourself and what you've been doing in this real estate space over the years?
Yeah. So I got my start outside of real estate. I was an engineer and business guy by education, and spent most of my career in Silicon Valley doing the high tech thing. 2008, my wife and I decided to get married. We were both doing tech and working way too many hours and traveling way too often. So we said, let's do something else that would give us a little bit more flexibility to put our family first. And so we fell into real estate in 2008. We spent about 10 years doing single family rentals and fix and flips. And then around 2018, I came to my senses and realized that that single family was way too tiring and stressful, and moved into multifamily. And I've been doing multifamily for the past 5 or 6 years with my partner, Ashley Wilson at Bar Down Investments.
Fantastic. So now I'm curious about that transition. So the audience, as we shared, is these are newer passive investors. So a lot of these folks have active investing history, just like you and I do. Yep. I'm curious, when you first got started, was it you were full-time in your W-2 and you were buying a handful of single families and flipping, or did you actually just cut the ties quickly and jump right in? Where did that transition look like?
We quit our jobs in the spring of 2008. We decided to get married in August of 2008, and we said we're going to take the next 4, 5, 6 months and figure out what we want to do. And we were leaning towards, at the time, maybe doing multifamily real estate, though 2008 wasn't a great time to be doing multifamily.
Sure.
We thought about starting our own businesses. We thought about becoming consultants. We talked about a lot of things. And while we were talking about it, we decided to flip a house. And that house flip turned into a second and a third and a fifth and a 10th and a 50th. And before we knew it, we had stopped talking about what we were going to do. And what we were doing was we were flipping houses. And so it just kind of naturally evolved. It wasn't a decision, to be honest.
Yeah.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Yeah, what an amazing time to get in the single family space too, because obviously everything that was going on there, you probably got some pretty good deals, I suspect, early on.
We did. Luckily, I was smart enough not to have any idea what I was doing. And I was dumb enough not to recognize that then might have been a really bad time to get into single family. But luckily, I didn't think about that. I didn't know enough to think this might not be a good opportunity. And it ended up being a great opportunity. And I mean, we talk about real estate back then being so easy to buy deals. But if in retrospect, yeah, it was easy to buy deals, but it was really tough to sell deals. And so at any point in the market cycle, what you're going to find is that it's really easy to buy or it's really easy to sell. And the other side of the equation seems impossible. And so here we are in 2024. Wow. Going quickly. But just a couple of years ago, what we were seeing was, or just up to a few months ago, what we were seeing was, I mean, selling was simple, but it's really hard to buy great deals now. And so it's not that things have changed fundamentally. It's just flipped from a buyer's market to a seller's market.
Got it. So So a single family flip business, that's obviously very, very heavily operations driven. It usually takes big teams. And really it's an entirely different business than the multifamily space. So what did that team look like that you had as you were buying and flipping all of those units? Was it just you and a couple of folks? Did you subcontract everything? What did that look like?
Well, I think that's contributed a large amount to my success in this business, my wife and my success, especially early on, that we were not knowledgeable at all about real estate. We bought our first house when we were 37 years old. After we left the tech industry, I'd literally never purchased a house before. So the house we were living in was the first we bought. I knew nothing about contracting. I'm an electrical engineer who can barely change a light bulb. And so when we got into single family flipping, I said, I can't do this. I can't be the guy that's doing the contracting work. I can't even be the guy that's managing the contractors. I don't know enough. And it really forced us to focus on the business side of the business. It forced us to hire great people who knew what they were doing and to manage those people well and to create systems and processes to really understand the P&L of the business and to understand cash flow management and understand how to raise capital and all those other things that are instrumental in any business you're going to do. It doesn't matter if you're flipping houses or own a car dealership or a restaurant or a shoe store. I mean, these are basic business practices and fundamentals that if you're good at it, it doesn't matter if you're doing single family or multifamily or any other type of business, because at the end of the day, running a business is running a business.
Absolutely. So the skills, you probably actually acquired the skills in your W-2, which translated really well over into what you were doing with single family. And then once you're able to lay those skills over the entrepreneurial spirit, it really can kind of flow over into bigger and better and amazing things. So that's a good lesson too. I think a lot of folks come into this space and maybe they think they're better at some of those other things than what you thought they were. Which looks like a benefit when you're first getting started, but really, from hindsight, it looks like your path to, the who not how strategy of hiring the experts from day one really paid dividends and continues to pay dividends. So really cool.
It did. And for a couple of reasons. Number one, it's a lot easier to grow and scale a business that you aren't working in directly. If I were the person that was painting my own houses, or even if I were just managing my own contractors, that would take away the time that I needed from finding additional capital and finding additional deals and doing all the other things that are instrumental in growing and scaling the business. Number one. Number two, when you're working in your business, let's say to save money, I wanted to paint my own houses. If I could find a painter for $30 an hour, but instead I painted my own houses, essentially what I'm doing is I'm replacing that $30 an hour employee or contractor. So I'm essentially making $30 an hour. I didn't get into real estate to make $30 an hour. I got into real estate to make $500 an hour or $1,000 an hour or $5,000 an hour. And there's really only two ways in this business to be making large hourly sums like that. And that's to be focused on raising capital or finding great deals. Everything else should be hired out.
Got it. Okay. So yeah, finding what your superpower was critical to your success. So you're saying that capital raising and finding deals is really the expertise that you need to lean towards. And do you do both of those today, or are you focused more on one of the two?
So I have a partner, Ashley Wilson. She's amazing. And what we've seen is for most syndication businesses in the real estate space, they're run by two people. Typically, it's somebody who is raising capital and then somebody else that's focused on operations. Maybe you have a third person finding deals. Maybe they're working together to find deals, or you outsource it. But for the most part, you have somebody who's focused on the capital side of the business and somebody focused on the operation side of the business. I happen to be focused on the capital side of the business. Ashley happens to be focused on the operation side of the business. And then we have folks under us that deal with finding deals and the day-to-day management.
Got it. So I know I want to continue through the process and talk about the onboarding of the multifamily and those first few deals, but I know in hearing you share at Best Ever in 30 days or so ago, you talked about the legal way to raise capital. And while this is an audience of passive investors, I think it's really important to dig in and make sure that passive investors understand some of the intricacies, like you shared from the podium. can you share maybe at a high level, like what's legal? And of course, you're not an attorney, so you're not giving legal advice,
Sure.
but what is the legal way and what's the illegal way that you see people raising capital today?
Sure. And I think the first thing that passive investors, LPs, should understand is the role of the SEC, the Securities and Exchange Committee, in all of this. And again, I'm not a securities attorney. I'm not an attorney, so take everything I say with a grain of salt. But generally speaking, if you are, or a group, let's say a group of people in general, are relying on somebody else to make the decisions, provide the knowledge, the expertise, and the efforts to make them money on their capital, and all they are doing is providing that capital, what you've created is a security. Anytime a group of people turn over their money to somebody and that somebody is responsible for generating a return, that's a security. And anytime you've created a security, it needs to either be registered with the SEC, or the SEC has to give you an exemption, has to basically say it's okay for you to do this as long as you follow these rules. And so that's kind of the difference between a security and a partnership. In a partnership, a bunch of people come together and everybody has voting rights. Everybody has some amount of responsibility, puts in a certain amount of work, puts in a certain amount of effort and money, and they share all the responsibilities, and they're responsible for their own outcomes. They're responsible for their own returns on their investment. In a syndication, or again, a security, somebody else is responsible for making the decisions and generating that return. And so when we do a syndication, we first need to register with the SEC, or we need to get an exemption from the SEC. And the SEC tells us what we can legally do to raise capital. And so some of the things they may tell us, depending on how we register or what type of exemption we get, they may say you're allowed to publicly market that deal, or they may say you're not allowed to publicly market that deal. There are different ways to register. They may say that you can take investors that you don't know who they are. You can find somebody out there on the internet, you can put up a billboard, they can call you, and you can bring them in.
Sure.
Other ways you register, they say, nope, you need to have a personal substantial relationship with these people before you allow them to invest. Sometimes the SEC says you can only work with investors who meet a certain financial threshold called an accredited investor. They have a certain amount of net worth, or they make a certain amount of income, or the SEC might say, nope, you can work with anybody that is sophisticated enough to understand the investment, but we don't care how much money they have. And so there are all these different rules, and depending on how we register with the SEC, we are responsible for following those rules. So as an LP, the first thing that's important to understand is, what are these different types of exemptions? What are the rules that the operator is required to follow, so that you know that if whether you're qualified to invest in that deal with that operator, and to know what standards the SEC is holding that operator to. And so there are two common ones that we talk about: a 506B and a 506C. In a 506C offering, we can take anybody regardless of whether they're accredited or not, but we're not allowed to publicly market the deal. And we can only work with people that we have a personal substantial relationship with. In a 506C deal, we can market the deal as much as we want. We can put it on billboards, radio ads, the internet, but we can only work with accredited investors. And so those are kind of the two big distinctions you should know about. But it's really important that the operator that you're working with, they understand the distinction. They know the right people that they can work with and they can't work with. Because at the end of the day, if the operator gets in trouble for doing something, that's going to have a major impact on the deal. And we've seen plenty of operators over the past couple, especially the last 18 to 24 months, that are starting to get in trouble. And the big reason that a lot of them are getting in trouble is because there's one other really, really important rule that the SEC imposes. And that's that people who raise capital cannot get compensated for raising capital unless they're licensed to do so. Unless they have a certain type of broker-dealer license, they can't be compensated. So if you have somebody that approaches you and says, hey, I'd love to bring you into this deal, and it turns out that they're a capital raiser. They're not necessarily leading the deal. They don't know a lot about the deal. They're essentially making an introduction between you and the people who are running the deal, and then they might kind of hang around, but they're not intricately involved in the deal. There's a good chance that what they are doing, if they're getting compensated for that role for bringing you in, there's a good chance that they're breaking the law. And what we're seeing is that there are a lot of people that are starting to get in trouble for illegal capital raising in this business recently. And again, why does that impact us as LPs? Because when somebody in a deal gets caught, that defocuses the whole group. Now they're focused on dealing with an SEC legal issues. They're potentially in court. They're potentially paying fines. They're potentially getting banned from raising capital in the future, and all that can end up derailing the investments.
Got it. Awesome. Well, yeah, thank you for walking through that. I had Mauricio on the show probably a year or so ago, and he walked through all the intricacies.
He probably said the exact same thing I said, but a whole lot better and a whole lot more quickly.
Well, hey, we all have opinions. I like the way you explain it, though. We'll just say that. So a couple of things kind of jumped up to me here. Let's say you're a new passive investor and you're talking to folks like you and I. You don't have what you don't consider a pre-existing relationship with them, and the operator is being covered by the 506B exemption. As an LP investor, trying to make sure that you're operating within the confines of the SEC rules, how would you determine whether you have a pre-existing relationship, and how can you know if you're sophisticated or not to even participate in these type of deals?
Yeah, I mean, the nice thing is that from a liability standpoint, a legal liability standpoint, the onus is not on you as the investor to ensure that you have that relationship or to ensure that you're sophisticated. The onus is on the operator, on the general partner, the general partners, to ensure that you have that relationship and that you are sophisticated enough. Now, again, it's nice to know if they are following the rules, because you know what legal risk they're at. Generally speaking, and again, Mauricio is a better person, or any securities attorney is a better person to answer this question. But a good rule of thumb is, and that I've heard, is 3 touches. And again, this isn't SEC verbiage, but it's an interpretation of the rule that you've had to have 3 personal interactions with that operator prior to that deal being in existence. So you've had lunch with them, or you've done a Zoom call with them, or you've had a phone call with them. Maybe you met them at a dinner party, or they were introduced by a friend. 3 of those personal touches generally constitutes a substantial relationship, from what from rules of thumb that I've heard. But the second part is all of those touches, that substantial relationship, needs to exist before the deal is in existence, under contract. If I were to get a deal under contract today, and let's say I got under contract this morning, and I said, "Hey, Randy, this is great to meet you. Let me tell you about this deal I had." And then I call you again tomorrow and say, "Hey, let's talk about your family and talk about the deal again." And I call you next week. That's 3 touches. But they started after the deal was in existence. And so the SEC would say, okay, it's very possible that I was creating that relationship simply for the purpose of getting this investment, as opposed to that relationship existing beforehand.
No, that is, and it's interesting too, because I've heard some folks that say, I've always used like this 30-day rule. Make sure that we have a conversation, make sure that they're on my email distributions, listening to the podcast, those types of things. So there is that thing. And then make sure that 30 days have passed in addition to all of that before we do it. And I've heard actually just this week that I should be looking for 60 days or 90 days. I'm hearing today, like physical touches, maybe that's more important, but it's nuanced. You hear me? It's because there's not been any, actually rulings that say because you did X, Y, and Z, it didn't satisfy it. So it's this gray area that the SEC likes to talk about. So it's important for folks like myself, other operators, to have a really good relationship with an SEC attorney so they can bounce that stuff off them. And if you happen to have a podcast with them as well, I'm sure that helps as well, right?
It does. But I will
Yeah.
say that there are a lot of operators out there that avoid doing 506B deals altogether because they see this as a risk and to avoid that risk. And that's why it can be very difficult for
Yep.
non-accredited investors these days to find deals sometimes because
Yep.
there are many fewer. It used to be that pretty much all deals were 506B, allowed non-accredited investors.
Yep.
Over the last couple of years, it's kind of shifted the other direction, and now it's much harder to find these 506B deals for non-accredited investors.
Yeah. I think I heard a statistic that 85% of all deals historically, including today, are 506B, which is surprising to me. Because it seems like the industry would shift towards a 506C so they would have the ability to advertise. But then you have this requirement where you've got to verify accreditation. It can't be self certified. So that's an interesting piece to this whole equation. So, well, let's. I actually operate in the fund-to-fund world, which, if you line up 10 different SEC attorneys, you're probably going to get different opinions. But I'm curious, what are your thoughts? Do you think that falls into the legal guidelines that are available, or do you shy away from folks that are in the fund-to-fund model?
So we do have a fund of funds. We specifically have one that's that's focused on the preferred equity space. So we invest in a type of tranche of equity called preferred equity. It's a little bit lower risk investment, lower on the capital stack. We really like the model. Certainly, again, there are rules that need to be followed. Turns out for fund of funds, there are more state rules than there are for traditional syndications. Determine how many investors you can have and to what level you can be a manager of those funds and what amount of control you can have, and probably well over my head from a legal perspective. But we are comfortable doing the fund of funds model. And again, it's always great to have, if you're on the operator side, it's always great to have good securities legal counsel that can keep you compliant. And you do want to make sure, even if you're just a limited partner in these deals, it's always good to ask who the securities attorney is that they work with. Maybe do a little bit of due diligence there just to make sure that it's a reputable attorney that other people have heard of. Because at the end of the day, it's the attorney that's going to keep your operating group out of trouble, and you want your operating group to stay out of trouble.
Yeah, that's a really good point. Just like any profession, there are good eggs, bad eggs, and everything in between. So to make sure that you're working with a reputable group that's not just copy pasting PPMs from one deal to the next is super important. Now, I know a theme that we're starting to see, and we're kind of going on a different track here than what I thought we would, but it's a conversation that I'm intrigued in, is we're seeing a couple of trends. One, we're seeing kind of this, I'm calling it this army of fund managers, where you're getting groups coming together that are raising bigger dollars, and they're bringing bigger check sizes to operators and then demanding bigger economics or better economics from the group. I'm curious if you have thoughts, if you've seen those, if you're seeing the same trends, and any opinion you might have on that.
Yeah, and I think the big shift today is that there are a lot of operators or people who are historically operators out there that are having trouble finding deals. And so, again, I mentioned earlier that there's kind of two sides to a syndication business. There's finding the money, and then there's operating and finding the deals. And when one side gets difficult, you kind of do what you can to focus on the other. And what we're seeing is it's difficult to find great deals these days. But a lot of these operators still have investors. They still have access to capital. And so they want to be able to continue to raise capital for a couple of reasons. One, obviously, if they can raise capital, they can continue to earn returns themselves. But two, they want to keep those investors around. If we have to tell investors we don't have any deals this year, and we didn't have any deals last year, and we may not have any deals next year, those investors are going to move on and find another operator to work with, and then you may have lost their attention. And operators don't like to lose the attention of their investors. And so operators would rather say, I will find you a deal, even if it's not my own deal. I will aggregate your funds with other operators or other capital raisers, and I'll put your funds into somebody else's deal. And there's nothing wrong with that inherently. The key is that if you can't find great deals, that it's probably difficult for other people to find great deals. And it's that much more important that whoever is aggregating your capital, whoever the capital raiser is really good at due diligence. Now, if you can find somebody who is good at due diligence, a fund of funds is a great way to diversify your investment, to lower your risk, because you're diversified hopefully across operators, you're diversified across locations, you may be diversified across asset classes, you may be diversified across exit strategies, you may be diversified across hold periods, you may be diversified across different places in
Sure.
the capital stack. Lots of ways to diversify your capital, and a good fund of funds manager is going to lower your risk, not increase your risk, through this diversification. But a bad fund of funds operator is basically going to take your capital and put it into deals that they say, this deal wasn't good enough for me to do, but I'm going to put your money into that deal with somebody else. And so I see a lot of people who think, if I'm going to invest in a syndication, it's important to do due diligence. But if I'm going to invest in a fund of funds, I don't need to do due diligence because I have a fund manager who's looking out for me. No, it's still really important that you do the due diligence. But in this case, you're doing the due diligence on the fund manager as opposed to the underlying property or investment.
Love it. Yeah, no, gosh, I'm going to grab that point right there, because that ties perfectly with what I'm trying to do with impact equity from the diversification standpoint as well. And what I'm seeing is as it's harder for deals, becomes harder and harder for deals to get done, you're seeing everybody jump into the capital raising space, and you're seeing fund managers starting to decide whether they do deals based on how much they can make on the deal versus the quality of the deal. And I'm of the mindset that I would rather make average returns for me personally to make sure that my investors are getting the best possible deal, because that one investor that does well will come back to you, as you know, over and over and over again if you do well with the dollars. But the second you lose $1, they've got every right to pull their dollars and go other places. So thank you for walking through that. I think this trend is good and bad, because of course, as everybody needs more capital now, it's harder to raise capital. You see everybody coming off the benches, and that's what they're trying to do. So, thank you it's interesting to get your perspective as well, because that's in talking with operators at Best Ever, my argument to them was exactly what you said, is if it's been 2 years since you've had a deal, why not use those due diligence skills and those acquisition skills that you have to go find assets, to go find deals, and make sure that the appetite of your investors is being met, because they will. I find that investors, when they want to place capital, they're going to place it, in the next 30 days in a good deal or not a good deal. So let's make sure that we're putting the good deals in front of those folks. So anyways, interesting. So let's, if we can, I want to come back and hear the multifamily journey. You had tremendous success in single family, which is very labor intensive, very tax burdensome, is my understanding, to be in the flip space. So you see a lot of people go through that transition from single to multi. Were those the reasons you switched, or was there something else that kind of drove you down that path?
Honestly, it was just the stress of trying to grow a single family business. It's a difficult business to scale. It doesn't scale easily. There are step functions. If you want to go from one deal at a time to 2 deals at a time, it's kind of a step function. You have to implement and introduce new systems and processes. To go from 2 deals to 5 deals at a time, again, step function. You have to implement new systems and processes. 5 deals to 10 deals at a time. And so every time you're trying to scale the business, it's not a linear scaling function. It's very much a step function, and it requires you to essentially recreate the business every time you want to scale. Now, if you don't want to scale, that's great. You can get really good at what you're doing and continue to do it. I'm somebody that gets bored very easily. And so I'm always looking for a new challenge. And in single family, that new challenge really involved scaling and going bigger. But I lost the interest in trying to scale that business. It got very cumbersome and stressful. So when we decided to exit the single family business, just like when we exited our corporate jobs, it was overnight. Woke up one day and said, okay, I'm done. And now I'm going to figure out what we're going to do next.
Sure.
And so we thought about going back and I do some advisory work in the tech world. I thought about just taking some time off. I thought about being a passive investor. And what I realized was, once the day I stopped flipping houses, all this cash started to come back. Every time we would sell one of the properties in inventory, we'd have a whole bunch of cash coming back because we did a lot in using our own cash.
Sure.
And within a couple months of stopping single family, I had a bank account full of cash that I had to figure out what to do with.
Sure.
And so it was a separate problem, but it was a related problem. I said to myself, well, if I'm going to be investing this capital, what's the asset class I want to be in? And
Sure.
the first thing I thought was, well, I know real estate. I like real estate. I like the tax benefits. I like the cash flow. I like the appreciation. So I want to be in real estate. What asset class do I want to be in? And did some research. And what I realized was multifamily has historically had the best risk-adjusted returns of any pretty much asset class on the planet, real estate or not. And so I thought I'd really love to be in multifamily. So the natural choice would have been to become a passive investor in other people's syndications,
Sure.
but I'm a control freak.
Right. I had a feeling we were going there. Yeah.
Yeah. I don't like just handing my money over. And I have been investing as an LP. I'm an LP in about 6,000 units since 2008. So I do that, but I didn't want to do that with a significant portion of my capital. So at that point I said, okay, well, if I want to be in multifamily and I want to invest in multifamily and I don't trust other people with my money, why not learn about multifamily myself? And so I reached out to my friend, Ashley, who was in multifamily at the time, and asked her to teach me the business. And she agreed to kind of take me under her wing and teach me the business. And what I realized was I could kind of have my cake and eat it too. I could invest in multifamily. I could get the returns I wanted with the risk I wanted. But at the same time, I could control my own fate by running the deals. And so in 2019, 2020, she and I teamed up, partnered up, and we've been working together ever since.
I love it. And it gave you an opportunity to step into another arena from writing books as well. Because I noticed that there are some different ones other than flipping books on the back shelf behind you there.
Yeah, I don't particularly enjoy writing books, but I think teaching is a calling for me. And so my criteria whenever I write a book is if it's something that I think I can do better than anything that's out there, or if it's not out there yet, I'll write it. And so definitely moving into a different asset class has given me some additional ideas for book topics.
Yeah, well, we appreciate the effort there. I know you don't make millions and millions of dollars on writing books, but the value you bring to the community is amazing. So thank you.
I appreciate it.
Well, let's, you've made this shift. You're now multifamily. Here we are in 2024 with some fun things going on with the economy. Some would argue the opposite. What is your take? Where are we in the cycle? Where are you betting today that the future is going to bring?
So first we have to differentiate between the economy and the real estate market. I know a lot of people who invest are probably a lot younger than I am. If you're mid 30s or younger, even 40 and younger, you probably only really remember one recession, and that was 2008. You probably don't remember 2001 or early 90s or late 80s or the four recessions between 68 and 82. And you probably assume that every recession is probably similar to 2008 because that's what you remember. But for us old guys who, one, remember more recessions than just 2008, and two, who have studied economic history, what you realize is that there's been exactly 35 recessions in the past 160 years. And of those 35 recessions, exactly one of them has seen a major impact on real estate values, and that was 2008. The other 34 recessions going back to the mid 19th century have had essentially no impact on real estate values. So long story short, 2008 was an anomaly. And a lot of people assume that 2008 is kind of the rule. If we have a recession, real estate's going to suffer. Turns out that it's just the opposite. Generally speaking, real estate continues to go up steadily over time, regardless of what happens in the broader economy. So it's really important to differentiate between what's going on in the economy and what's going on in real estate. And I think, let's start with the economy. I do think that we are likely headed towards a softening, maybe even what we would call a recession. We're starting to see more signs, especially over the last couple of weeks. If you would have asked me this question 2 months ago, 6 months ago, I would have said, I think we're looking like we're in for a soft landing. Seems like the Fed has done a pretty good job, but now it's looking like the Fed may have overcorrected by raising interest rates a little bit too quickly. And I am concerned that we may have overcorrected and we may be heading towards a softening in the economy, and that we could be struggling for in the next 6 to 12 months. Now, that said, there's a lot of reason to believe that real estate is not going to take a hit, or at least single family real estate. Let's start with single family real estate.
Okay.
Number one, anytime there's significant inflation, that's going to prop up real estate values. When we have inflation, investors want to put their money in hard assets because they know hard assets are the best hedge against inflation. And single family real estate is probably one of the easiest hard assets to purchase. So that's number one. Number two, just supply and demand. We are undersupplied by about 7 million units in this country, given the number of households that formed over the past 15 years and the number of units that have been built. And so that undersupply is going to keep prices propped up. And additionally, there's a lot of demand still. There's about $300 billion sitting on the sidelines, ready to put their money into some form of hard real estate investment. And so as interest rates come down, as prices maybe start to soften or look like they're going to soften, I think we're going to see a lot of demand for that real estate. So between inflation, low supply, high demand, I think real estate values, I'm not saying they won't go down a little bit. If we see a significant softening in the economy, we may see real estate prices go down a little bit, but I think they're mostly going to be propped up.
Yeah, actually, real quickly. So, you mentioned all the money that's sitting on the sidelines that could come flooding over to the real estate market. I know there's been a shift, though, also in homeownership trends. So we're seeing this population group that is decidedly just never going to own homes, potentially, which could have some long-term impacts on that. I'm curious your thoughts on that.
Yeah. So, I mean, it's funny. If you look at a graph of home ownership in this country over the last 50 years, it's tremendously steady. We're between 63 and 69% home ownership rate, going back as far back as I've been alive, which is 50 some years. And while that number is trending down a little bit, we're still kind of right in that sweet spot of about 64% home ownership rate. There is reason to believe that it could drop to 63, 62.5% over the next decade, which, don't get me wrong, that's significant. I mean, if you're talking about 1% of 300 million people, that's a big number. But it's not like we're going to see half as many people in houses. But we are seeing that number trend down. We're definitely seeing a trend towards renting versus home ownership. And so that's going to impact supply as well. As more people want to rent, we're going to need more units to rent. And so that's going to impact as well. And the cost of home ownership right now, I saw a stat a month or two ago that home ownership is 52% more expensive than renting right now. So anybody that's going to sell their house right now is unlikely, given number one, interest rates, but also the cost of home ownership. They're unlikely to buy a new home right now. They're probably more likely to rent. And so that's another reason I think we as landlords are in a good position right now.
Got it. Okay. So that's the economy. And then real estate. Let's jump into that. What are your crystal balls views for the coming years?
Yeah. So if you jump into multifamily real estate, things are a little bit different. 2 years ago, we saw a major softening in multifamily values. We saw values drop about 25, 30% right after interest rates started to go up back in 2022. But what's interesting is that drop happened fairly quickly. From about March of 2022 to about September of 2022, we saw cap rates increase. We saw values drop about 20, 25%. Since 2022, that last year and a half, we've seen we've seen values come down a little bit, maybe another 5%. But for the most part, things have stabilized. And for the last 12 to 18 months, multifamily values have been relatively stable. So there's reason to believe that if we're not at the bottom, we're probably pretty close to the bottom. Assuming we don't see major inflation that causes the Fed to reverse course and raise interest rates again, it's likely that the next moves, and it may be 6 or 12 months from now, but the next moves for interest rates are likely down. And as interest rates go down, hopefully cap rates will start to come down as well. So I think it's going to be a long ride back up. I don't think we're going to get back to 2019 or 20 or 21 values anytime soon in multifamily, but I do think that we're probably pretty close to the bottom. And from here, hopefully things will start trending up over the next 6 to 12 months as interest rates come down.
Got it. So would you, the conversations I've been having with investors is my belief is that now is the time to be buying, and that there are better deals in the marketplace today than anything we've seen in a couple of years, certainly in the deals that I've invested in, the deals that I've partnered with on operators as well. Do you agree that now is the time, or do you still think it's, wait and see, give it another 6 to 12 months before the true opportunity exists?
I think it's close. If
Okay.
not now, I think the next 6 to 12 months, it will be a great time for one simple reason, that the Fed is starting to give us second thoughts on whether they're going to lower interest rates this summer. So
Yeah.
as of a year ago, I think a lot of multifamily operators who were holding properties that may have been struggling or facing a refinance coming up or facing a new rate cap expiration were saying to
Yeah.
themselves, well, in the next few months, we're going to see the Fed lower interest rates. That's going to spur the market. That's going to make our lives easier. We're going to be able to refinance at higher rates. Our DSCRs are going to come up. We're going to see more cash flow. We're going to see lower rate caps. We're going to see all these things that are going to help us. Now that the Fed has kind of indicated that it may be 6 or 12 months before we see that first rate cut, I think there are a lot of multifamily operators who are recognizing that period of rainbows and butterflies and everything being perfect again could be pushed out another 6 to 12 months. And in the next 6 to 12 months, we've got several trillion dollars worth of multifamily loans coming due. We've got rate caps coming due. And so I think there are going to be a lot of operators who were hoping that this year was going to be the year that everything turned around that are now realizing that that may not happen. And yet they're still up against some cliff or some
Deadline.
major economic event this year, like a refinance or a rate cap expiration.
Yeah. You mentioned on a recent podcast that the Fed is doing some things with the balance sheet that could potentially impact inflation as well. Can you talk to that briefly as well? Because that was an interesting take that I'd not ever heard. So.
Yeah, so the Fed controls interest rates in a couple of ways. One, they can set the short-term interest rate, this thing that we call the federal funds rate, this thing that went from about 0% to 5.25% over the course of a year or two. And everybody was saying, okay, well, that's basically going to slow down the economy. And now we're seeing inflation, I don't want to say pick up, but it's not it's not going down the way it was that everybody would hope it would go down. We're still seeing some signs that inflation's a little bit more persistent than we were hoping, and yet the Fed is not raising interest rates any longer. So a lot of people are concerned that okay, maybe the Fed's easing up and we're going to start to see rate drops. But behind the scenes, there's another thing that the Fed does that can control inflation, and that's basically playing with the money supply. So as they put more money into the money supply, that kind of puts more cash out there for people to spend, which induces inflation. As they take money out of the money supply, it does just the opposite. There's less money for us to spend. There's less money to go into businesses and goods and services, and that slows down inflation. And so behind the scenes, what they're doing is they're slowly pulling money out of the money supply. And they're doing that two ways. One, they have a balance sheet. They have a whole bunch of assets that they bought that as those assets expire, instead of buying more assets, putting more money out there, they just let those assets roll off their balance sheet. So that money's kind of going away forever. And then second, we have this thing called the money supply, and you might hear it referred to as the M2 money supply, which is the amount of capital that kind of flows through banks and through our economy. And for the first time in about 80 years, what we're seeing is that money supply is shrinking. Generally speaking, that money supply only goes in one direction. We only print more capital and release more capital into the markets. For the first time in 80 years, that money supply is shrinking. So we're pulling money out of the markets. And so while the Fed isn't raising interest rates any longer, they are taking capital out of the markets, which kind of has the same effect. It's the equivalent of raising interest rates a quarter or a half point. And so hopefully that will be enough to kind of quash inflation and really allow things to start moving in the right direction. And I think once we get a signal that inflation is under control, that's when the Fed's going to start cutting rates. And I think that's really when we're going to see multifamily and other commercial values return.
Awesome. Thank you for walking through that. That was the first time I had heard that on the podcast. I think it was a couple of weeks ago. And it was interesting to hear how just simply Fed monetary supply strategies has a similar impact to inflation as interest rates do. So, the optimist in me thinks why not remove more capital from the money supply and then drop the rates, and then everybody's happy. But they're not calling me asking for my advice, unfortunately. So, well, gosh, I mean, we're already at 40 minutes. I promised you 30, Jay. I feel like I haven't even asked half of the questions that I wanted to ask you, but this has been a lot of fun. I certainly want to be respectful of your time, but I do have a few questions that I like to ask everybody before we wrap up a podcast, if you're okay with that. All right. So being the expert that you are with all of the books behind you, I'm going to ask if there is one educational resource, whether it's a book or a podcast, that you would suggest to the new or newer passive investor, excluding your own titles and podcasts, because we've already talked about real estate, drunk real estate, which is fantastic. What would be some advice to the newer passive investor?
Yeah, and I'm guessing you've had a lot of people already recommend this book, but there's an amazing book for anybody that's a passive investor or wants to be a passive investor out there, written by Brian Burke. It's called The Hands-Off Investor. So highly recommend that book. I also highly recommend, and I think of this because Brian was a guest on their podcast just last week or 2 weeks ago. BiggerPockets has a podcast called On the Market, which is heavily economics focused and real estate market focused. Great podcast that I would recommend anybody that's interested in more data driven analysis of what's going on in the markets to listen to the On the Market podcast. It's hosted by a number of folks, but primarily by Dave Meyer, who is the head of analytics for BiggerPockets.
I love it. I love it. I was a very heavy BiggerPockets listener early on, and I had shifted away. So that is a good reason to get back there. I will definitely check it out.
I don't listen to the real estate podcast anymore, but the On the Market podcast is fantastic.
Awesome. I'll check it out. All right. And then I have a couple of fun questions here. Is there a recent bucket list item that you've checked off your list, or one that you hope to in the near future?
This is horribly, horribly embarrassing, but after being married for, 15 and a half years, my wife and I are getting ready to do our honeymoon. So I mentioned earlier that we started flipping houses, and we were in the middle of 2 house flips on the day of our wedding, and we decided we can put off the honeymoon until next year, and then next year, and then next year. It's now been 15 and a half years, and so I can't cross it off my bucket list yet. Yeah. But it looks like in the next few months, my wife and I are actually going to go on our honeymoon during our 16th year.
Very good. And have you booked it yet? Can we check that one off the list, or no?
My wife, who is the best, is in the process of booking us an amazing trip to Italy.
Outstanding. One of my favorite trips of all time was to Italy. So very good. All right. Kind of a fun one here. If you had $100,000 that you had to invest before the end of the week, actually, let's say the end of next week, because we're already Friday, and you could not place it into one of your own deals, where would you place that capital?
So it's such a tough question. And the answer is, and I hate this answer because it's so rare that I give this answer, but I would probably hold on to that capital for a couple months. Okay. I'm in one of those. I generally am not one of those people that suggests hoarding capital. I like to have my capital working at all times. But right now, I think we're in a really good wait and see opportunity. Okay. I do suspect that in the next couple months, we're going to see some really good opportunities. It's not yet clear to me exactly where those opportunities are going to be. And so I would say, if you have a little bit of extra capital, now's a good time to be sitting on it. If I have to say like where to invest, like if I was forced to invest that money, I would go with the tried and true. I like multifamily real estate. Again, long-term, best risk-adjusted returns. And this today might not be the best day for real estate, for multifamily real estate. Tomorrow might not be the best time, but most syndications, most funds are going to be 3, 5, 7-year funds. And I think there's no denying that over the next 3, 5, or 7 years, multifamily is going to have a strong comeback, and the returns are going to be fantastic.
Agree, 100%. And then a final question is, when you're doing due diligence, is there one due diligence question that you ask that uncovers things that you might not uncover without this special question?
Yeah. And so here's my favorite. And I'm going to have to give my partner, Ashley Wilson, credit for this. She did a presentation at a big conference a couple years ago called the Cap Rate Con. And the presentation was all about how for the last 10 years or so, pretty much every real estate syndication has done tremendously well. It's been hard to lose money over the last 10 years up to a year or two ago. And a lot of syndicators, a lot of operators want to pat themselves on the back and talk about how great of a job they did. At the end of the day, value is made or profit is made in syndication by selling a property for a lot more than you buy it for. Obviously, cash flow is important. Other things are important. But at the end of the day, the bulk of the money is made by selling a property for more than you bought it for. And we all know that the value of a property is measured by its net operating income, NOI, divided by the cap rate. And so in order to hit projections for a multifamily property or any commercial real estate investment, there are two goals: to increase NOI as much as you possibly can, and to hope that cap rates go down in the process, or at least don't go up, to get you the highest sale price. Well, while a lot of us as operators like to take credit for the amazing job that we've done over the last decade, the reality is that all we can control is that NOI number. We can't control the cap rate number. And if you look at most syndications over the last decade, and I include myself in this, I'm a culprit of this as well. If you look at most syndications that have exited over the last decade, what we find is that the NOI wasn't increased to the point where the operator had predicted it would be when the project started, but because cap rates fell so much, we saw values much higher than the predicted outcome. And so essentially we were successful despite the fact that we probably didn't do as good a job as we could have done forecasting our NOI growth. And so what I recommend for anybody who is doing due diligence now, ask your operators how, in your previous deals, the deals that have exited over the last few years, how did you do with respect to NOI compared to your original projections? And don't get me wrong, very few, if any, are going to be able to honestly tell you that they hit their projections. So not hitting projections shouldn't be a disqualifier. But what you want to see is that operators are at least looking at that number and at least recognize the fact that a lot of the success they've had over the last decade has not been because they've necessarily achieved their business plan, but because the market has conspired to help them. And if we recognize that, and if we take into consideration that maybe we're not as great operators as we thought we were, we can use that information to really improve our ability moving forward, so that in the deals we're doing, that we're originating today and tomorrow and next year, for those deals, we really can do a better job of projecting the NOI, because I suspect that we're not going to get that cap rate boost that we've seen over the last decade over the next decade.
I love it. That is such a great question. And I'm trying to figure, certainly you can ask for NOI numbers, but I'm wondering if there's a good rule of thumb, like over the course of, is there a certain percentage per year that we should be shooting for, or looking for some threshold? Like, what is that number that shows that they've executed well? Even if they don't hit projections, is it a 10% improvement over X amount of years? That's the number you're shooting for. I'm curious.
And honestly, for me, I just want to know that they've thought about this topic, because it's so important. And if I'll ask the question, so what was your NOI compared to your projected NOI for the deals that you've exited over the last couple of years? And if the answer is, I've never even thought about that, that's a yellow flag. If the answer is, we've run those numbers and we didn't get anywhere close, obviously that's never a good sign. But most of us, and again, myself included, a lot of times the true answer is we didn't get close, but at least again, we've recognized it, and we're using it to calibrate moving forward and do a better job on future deals.
It's so funny you say that, because I've got this 68-point due diligence checklist that I use, and I'll share it with folks and say, you don't even really have to know what you're asking, but look to see what happens to their face when you ask the question, right?
Absolutely.
And to your point, exactly. If they've given it some thought, they have an answer, and it sounds sound, then at least they're thinking about these things as well. So,
absolutely.
Well, Jay, this has been a really fun conversation. I feel like I'd love to have you on a dozen more times, but maybe we'll be able to do this again in the future. Really enjoyed the conversation, Jay. For folks that want to reach out to you and to learn more about what you guys are doing at Bar Down, how can folks find you?
Yeah, it's easy. Just go to jscott.com, JSCOTT.com, and that will link you out to everything I'm doing. And also my email address is there for anybody that has any questions or wants to reach out to me.
Fantastic, Jay. Well, thank you again. This has been a lot of fun, and thanks so much for joining us today.
I appreciate it.
All right. To the audience, as always, we urge you to continue that education journey, but more important than that, we urge you to make the decision to place that first passive investment. Both Jay and I are convinced that once you do, you'll be so happy that you did and just wish that you had started sooner. So be sure to join us again next Thursday for another great episode. And thanks so much for joining us today.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.